Capital investment decisions, more than anything else, determine the survival and growth of any enterprise, be it business or service, governmental or non-governmental. This is so because capital investment projects, or simply projects, involve a commitment of large amount of funds in non-liquid assets such as plant and machinery. The benefits from these non-liquid assets accrue over an extended period in future. Project decision is then, in a sense, irreversible investment and carries a high degree of risk. Project evaluation is essentially analyzing the benefits and costs to find out the project's acceptability or otherwise, and is the most critical activity in the life of an enterprise. There is a variety of capital projects undertaken by various project authorities. Management in public and private sectors evaluate projects. So do financial institutions like IDBI, IFCI, ICICI and the World Bank, and each evaluates projects in its own environment. What are the perceptions and practices in evaluating a project? How do project authorities evaluate capital projects? What financial criteria do they use? Do they include economic and social aspects into analysis? If so, how? How do they assess and include risk and uncertainty in project evaluation? These are some of the questions that we would like to explore in this program. To begin with, let's see how managers in public and private sectors evaluate projects. What financial criteria do they use?
In case of IRR, we actually go by that. In case of IRR, we look a return from 15 to 20%. Because after interest cost, after depreciation and everything, first is the project should be viable and profitable in first 3 years. Because in first 3 years, you have to create infrastructure, you spend a lot of money in bringing your name in the market, setting up the market, creating the people, training the people, all sort of things you have to do in first 3 years. And thereafter, your investors, your fund institutions look at a dividend also. So we look at it from 5 years to 7 years should be a payback period and should be sufficient funding available for servicing your shareholders.
As far as ONGC is concerned, we are evaluating the projects more on NPV basis, IRR basis. Because in our view, this payback period is not a very sound method for evaluation. Payback period only takes into consideration some of the aspects. That is, well, how much period money is paid back. But it does not take into consideration the value of the money which comes into and what times. For instance, payback period, suppose it is a 4-year payback period. Well, one may feel that it is good investment. But question is, suppose the money is coming primarily in 3rd and 4th year. In one case. And in another case, it starts coming right from the 1st, 2nd, 3rd, 4th year. So then evaluation differs. So we don't adopt the technique of payback period. Rather, we go with the net present value method.
The evaluation of projects is very traditional and follows a fairly well-beaten path. Various financial criteria are applied. Payback period is the most mundane and the oldest, I would say. NPV, discounted cash flows, return. But in addition to the financial criteria, and one being a financial person, I must admit one is easily swayed with the seeming exactitude of the results given by applying financial criteria into believing that they are the end. But one must also go into the qualitative factors. There are often very many strategic reasons for which we want to expand or go into a new line, because we find we would like to expand because we want to retain our market share. The market is rapidly expanding and we don't want to become the runners-up for the also-rans. On the other hand, we may like to turn our emphasis to a new line because the activity which we have been pursuing all these years will be a sunset industry. and we have to get into the new areas which hold more promise in the future. Various other strategic reasons which do not translate very easily into financial criteria are also very important and should not be overlooked.
Generally, in our case, according to the Planning Commission guideline, we have to adopt IRR as a criteria for project evaluation. 12% IRR is what is required to be achieved in the power project. Now, there is a difference in this case between the private sector approach and public sector approach, because here this IRR is without taking into account corporate income tax. Because here many of the power sector, many of the highly capital intensive companies, they don't pay income tax because of the high incidence of depreciation on the plant and other tax concessions available. Income tax is not there. And apart from that, income tax basically represents transfer of funds from the public sector company to the government. And basically even contribution to the exchequer by way of income tax is considered a sort of contribution by the company. And so income tax is not taken into account according to Planning Commission guideline. Apart from IRR, we are also working out the return on investment. And then we work out what will be the power tariff based on the return. Because government expects us to achieve 10% return on equity. That means we must meet all our expenses, we must also meet the interest costs for the borrowings raised for the project, and in addition we must generate 10% surplus on the equity capital, which belongs of course to Government of India. So with that 10% equity, we try to indicate what will be the tariff for the power station. And then government considers whether this tariff is reasonable, whether the public will be in a position, will have the paying capacity for discharging this, these payments.
There is a variety of financial criteria used both by managers in public and private sectors. These include payback period, internal rate of return, return on investment, and net present value. The IRR, however, is the most popular. The choice of financial criteria depends upon the expectations of the stakeholders and statutory regulations. Is it only the financial criteria, or are there economic and social considerations which influence the project evaluation?
Normally not, because we have gotten certain obligations from the government, from the banks, from institutions, everywhere, and that is because there's nothing is an obligation on us. Obligation is once we are able to put the project, put into profitability and viability, servicing to all your collaborators, your bankers, your investors, everywhere. The social cause is our optional and necessity for attracting the people. That we will also inbuilt in the project, not otherwise.
Social considerations are of paramount importance. The first and the foremost social consideration that comes to mind immediately, probably on account of the importance given to it in the press, is the pollution laws. One has to be in full compliance with the pollution laws. Quite apart from the statutory and mandatory requirements, we have to cater to the welfare of our own employees who live in the colony and of the surrounding inhabitants. And we have also noticed that once we give attention to this aspect, there are very many commercial spin-offs of a beneficial nature which accrue to us. We take a very simple example. We operate a distillery at our factory because the basic feedstock for our company is industrial alcohol. In the process of meeting the industrial standards, industrial pollution control standards laid down by the UP State Pollution Control Board, we find that we can treat the effluent to meet the standards. On the other hand, from the same effluent, we can get biogas, which is rich in methane, and is used as a fuel substitute in our boilers, various energy requirements. And in the current and ever escalating prices of energy, this is of crucial importance and has a very significant bearing to play in the profitability of our company.
We, being in public sector and being a National Institute for Oil Exploration Development, we have certain social obligations to the society. So we evaluate the projects not only on internal rate of return but on economic rate of return. because internal rate of return gives the viability of the project on the returns to the organization and not returns to the society. Whereas economic rate of return keeps into consideration the cost to the economy, cost to the society, and those factors are taken into consideration both for inputs and outputs.
While evaluating the project, we do take into account the economic considerations first, because the power project has got a multiplier effect of 10. That means every unit of electricity, let us assume a unit of electricity sells for 50 paisa. With every unit of electricity, we expect the GNP will go up by 5 to 6 rupees. So, because we are in the core sector, the impact, there is a cascading effect of the production that we have in our projects on the national income. In addition to that, we also try to conserve foreign exchange, because considering the present foreign exchange shortage, we try to explore the sources for indigenous supply. And then while evaluating the project, we do some shadow pricing for foreign exchange, just to establish how the viability of the project will be affected if the foreign exchange rates go up, or there is some scarcity. Due to scarcity, if adequate foreign exchange is not available, then what other steps we will take to get the supplies.
Economic and social considerations are directly influence the project evaluation in public sector enterprises. Economic IRR, besides a financial IRR, is adopted by them. But in private sector enterprises, the influence is rather indirect, and that too in terms of a likely commercial spin-off. Risk and uncertainty are inherent characteristics of capital projects. How do project evaluators assess and incorporate it?
I think that's a very crucial question and a very good one. Here we go deeper into the qualitative factors. See, not only is the analysis and the appraisal, analysis of figures and appraisal of the project important, we have to ask ourselves some very fundamental questions. For example, the know-how or the technology we have bought or are in the process of buying, will it actually work in our environment? Will we get the end product we are looking for? It may seem we will, but very often, as experience has told us, the results are different. Okay, we go one step further. We are reasonably assured or totally assured that we will get the product we are looking for, which will comply and conform with the specifications laid down by the end users in the market, and it will be marketable. Will it be manufactured at the cost that we have assumed in our projections? Will the consumption of various inputs remain within the parameters laid down? Another factor which has to be considered. And these do not easily translate themselves into figures. So some sort of sensitivity analysis has to be done. What if that particular raw material, which is probably the most important one or the most expensive one, goes up 10% in cost? The cost may go up because the vendor charges us more. The cost may go up because the consumption norms undergo a change. Having reassured ourselves by whatever means we have at our disposal that the product of marketable quality can be produced by the process we have at our disposal or we intend purchasing, and will be produced within the cost we have estimated and consequently cause us to make a profit, we then have to examine whether the product is marketable in the quantities that we intend to produce. For example, the product may have so far be an entirely imported item, which the particular user just imports in small lots. Having it available domestically could result in one or two scenarios. We have a product available in such vast quantities that the market for that does not exist. Consequently, we should have seed marketed the national scene to develop the market virtually and assure offtake. On the other hand, because the product is available domestically, the overseas suppliers of that product are likely to resort to dumping with a view to push us out of the market. This is where tariff controls, lobbying with the government comes in, and it's a very important factor.
For those projects which take a longer period in completion of the project, 3 to 4 years, where a lot of assumptions are made, when one makes assumptions, those are always subject to certain sensitivity. And there we, to be sure about our evaluation, we keep the sensitivity of each cost, that whether it is sensitive, and if it is sensitive, to what extent it is on plus and minus side. So those factors, those costs which are subject to certain sensitivity which can vary, we make the sensitivity analysis, that is, suppose cost is increased by 10%, or suppose the cost comes 10% less, or suppose the selling prices is 10% more or selling price is 10% less, or suppose certain the foreign currency cost. Foreign currency cost today it may be 21, but tomorrow suppose we have assumed 10% exchange fluctuation, but then we can make, suppose the exchange fluctuation is 15%. What would be the position? So like that, each cost is put to subject to sensitivity, and then we make analysis under 3 or 4 options, and that gives an idea, and that again makes us to think whether project is viable under various considerations, and we would not be committing a mistake in our evaluation.
The power sector projects are generally in the core sector, and at present in the country there is a overall shortage for power. Generally speaking, the risk element is not much there, but risk arises this way, in the sense that if we are putting up a power plant, if matching facilities are not available in time, then there will be delay in commissioning of the project, which will result in additional cost to the nation and unnecessary financial and interest costs. To avoid this, in the project report, we try to identify what are all the matching facilities that are required. That there is a coal, there has got to be a coal project. The coal mines have to be developed in time. Then some cases there has to be a storage water facility. A dam has to be put up. Then in the case of bulk movement of coal, railways have to put up additional track, or they have to confirm that the wagons will be available. So all these steps are indicated in the project report itself. We do a sensitivity analysis. That is, in our case, the major inputs are coal. Then the capital costs are also there, where foreign exchange is utilized. There is a foreign exchange fluctuation, which will also add to the project cost. So we make a study. If there is an increase in the price of coal, let us say by 5 or 10%, what will be the impact on the project cost and ultimately on the tariff? And a similar study is made in the case of foreign exchange also. With the variation, what will be the impact on the tariff?
We would like to see the first marketing. We get a marketing survey conducted by the experts in India as well as abroad, if it is relating to the exports. Then during the costs, we would like to have it our own and inbuilt for any future escalation. We must have find, and this is very unfortunate for the country, all our state governments, all our national fund institutions have a long list of the sick units. Mostly they have suffered because of lack of working capital. All our technocrats suffer because of the lack of capital and working capital at the fade end of the project. Not early. They will come later because they are not able to inbuilt a contingencies into it.
Sensitivity analysis and provision for contingencies are the 2 main modes of assessing and incorporating risk and uncertainty in project evaluation. How do financial institutions evaluate project? What is the main focus that a domestic financial institution such as ICICI have in evaluating a project?
No, I think the evaluation procedure is quite standard. Most people know about it, that one has to look into the requirement of funds, how the funds are going to be met, what's the profitability and other details. But at the management level in a financial institution, one has to be more careful, and most of our time is spent on evaluating the managerial capabilities of the people who are behind the project, and what is their track record in terms of implementing industrial projects, whether they know about the problems of the industry, how they have been tackling them, and whether they have created a kind of organization which is necessary for the successful implementation and operations of the project. We in ICICI think that that is very critical to the success of a project. Other details are important. One must have looked into all the various aspects of the project implementation in the state of return. But unless there is a strong management team, even a project which is otherwise good could suffer substantially. So we spend a lot of time making inquiries about the people, what is their financial background, what is their business experience, how they deal with people and their customers. And we also make a detailed assessment of their team, or management team which they have created. And that we think is very essential in any appraisal exercise.
Managerial integrity is thus the main aspect that the financial institutions look into while evaluating a project. Do IDBI, IFCI and ICICI differ in terms of criteria while evaluating a project?
Criteria, no. Certainly not, because we do follow certain standard norms. All three of us are development financial institutions. We are essentially following the same set of norms, because all of us share the risks that are involved in most of the projects. So I don't think criteria of appraisal differs at all. I mean, it would be financial indicators. It will be debt equity, the debt service cover ratio, the current asset ratio, which comes up after 1.5, 2 years. All those ratios would essentially be the same. There would not be any difference at all. The difference in style of appraisal would not be there, not at all. Individual differences arising out of personal approaches, personal attitudes, I'm sure they are there. But they I'm sure exist within our own organization itself. I'm sure they exist within any other organization. One man doesn't see the same way as somebody else, but the criteria will not differ.
Now, how does an international financial agency like the World Bank evaluate capital projects?
The social aspects of projects, I think, have been a concern of the bank ever since its inception. And so those factors are taken into account. Certainly with regard to environmental factors, the World Bank also takes those into account. And I think worldwide concern about environmental issues in the last 10 years has accelerated everybody's concern who are involved in development or in project activities. So that probably we are more aware and more sensitive today in trying to estimate environmental costs to particular project activities than we might have been 10 years ago. But as we have talked before, I mean, project development and project appraisal activity is a developing science, it's a developing art, and so perceptions change. And in looking at things like social and environmental factors, it raises a very, very crucial problem that we face sometimes in our own project appraisal work. And that is the problem of estimating the benefits and the costs. An irrigation scheme in a very, very dry agricultural area may have tremendous benefits to the farmers in the area, but it may involve the loss of some aesthetically attractive, natural forests or other visually attractive heritage, natural heritage that the country has. The problem is to then weigh the relative merits of one side and the other with regard to these types of assessments of costs and benefits. A healthcare project in Kerala for pregnant ladies, which is involving a supplemental nutritional program for lactating mothers or something like this. The costs of the program are relatively straightforward probably to assess. It's the cost of providing the service, food, and some of the supporting infrastructure to bring about that program. Now, the benefits of the program are much more difficult. It should bring healthier children. It should bring a reduction in nutrition-related diseases. It should bring an improvement in educational attainments, possibly. Particularly, you know, with young children with a deficient diet, it really does affect its intellectual growth capacity. And long-term statistics like infant mortality and other things should decline. Now, how to put, then, a quantified number to these benefits is very difficult. You can say, well, how much do we spend, for example, on health care for children under the age of 5? How much of it is going for nutritional-related diseases, like gastroenteritis or something like this? But even that would be, I think, nowhere near foolproof as to the true benefits that occur. Because full childhood development, intellectual development, healthy development, in conjunction with education, creates that human resource 20 years hence, which is a wonderful asset to the state of Kerala and, of course, to the economy of India. So, in some of these cases, trying to quantify the benefits may not be very fruitful. It might just be better to try and illustrate what the benefits will be. But the magnitude of them sometimes should be maybe left to a little bit of you know, lack of clarity, so to speak, in the context of the project itself. And that means not trying to put a spurious number to a benefit which you know from the very beginning is probably not very accurate. So we try to avoid that if we can.
To conclude, project evaluation is a multifaceted activity. It covers financial as well as economic or social evaluation. Strategic considerations such as market share sometimes become an overriding factor. Sensitivity analysis is the most common mode of assessing and incorporating risk and uncertainty. Interestingly, while the management focuses its attention on financial and economic evaluation, the financial institutions focus its attention on managerial integrity. Project evaluation, thus, is organization come project-specific activity.